5 software stocks to buy and hold forever. Today, we're going to be looking at 5 stocks that I own, some of them that I recently bought because they are at a steep discount. And we're going to take a look at type of companies that you can buy and hold forever that are the type of holdings that are not about growth rates or UI. They are about control. These companies run workflows that organizations and enterprises cannot legally and operationally turn off or economically turn off. They sit on the failure path. If they disappear, think about the warehouses stopping, okay? Products don't get shipped. Audits fail. Regulators intervene. Payroll breaks. Security collapses, okay? These are the types of companies that I want to have as deep vertical moat when investing for the very long term. Basically, I want to sleep very well knowing that my companies are not just gonna change with the wind. They're not trends. This is a strategy that ignores popularity completely and focuses on software that becomes embedded, customized, and unavoidable. Once installed, it does not get replaced. It just gets expanded, okay? So first stock is the best company that I have ever owned and is a recent addition because it has dropped recently significantly in price, and until now I have not had the opportunity of buying it. This is ServiceNow. So ServiceNow is trading at a 141, 142, let's say. Historically, all-time high was in January back in 2025. It was trading at 240, so about $100 from the share price has come off. As you can see in the graph here, let's put it on Google Finance here now. Down 37%. Wow, that's a significant drop. I mean, actually makes me want to, 40%. Yeah, that's a very sweet entry point. And this is not from the very all-time high. This is 234. It's probably a bit more than 40% down. Significant discount for this extremely high quality enterprise software. So what does this do? This is enterprise control plane, okay? Approvals, incidents, audits, change of management, governance, okay? Organizations do not function around ServiceNow. They function through it, okay? They have deep customization for enterprises, massive switching costs, and they are a budget priority. Enterprises don't negotiate very hard on ServiceNow. This is non-optional software, okay? Once this gets running for the company, it becomes mandatory. It's not something that once installed can get easily replaced. It only gets expanded over time. So let's take a look at financials a little bit. Revenue. This is a very fast growing company as well, which is extremely good because you can get not only very relevant and deep vertical moat type of company, but you also have the opportunity to get it now while it's still growing a lot. Not just double digits top line, but more than 20% consistently. Look at this. 2025, it's grown more than 20%, 2024, 22%, 23% in 2023. Well, that's nice. 22% in 2022. Well, 30% in 2021. Yeah, these numbers are very solid and consistent. I mean, they're not falling off of a cliff. Going from 47 down to 38, completely acceptable. Slowing down, but 38% is still extremely high. And then going down from 38 to 38, not even a 1% difference here in the numbers. And then 36%. So growth is slowing, but as you can see, it's still high growth consistently. Okay, let's take a look at the revenue by quarter. Look at this, how smooth it is. Every single quarter. So not only year over year this is growing, but basically every single quarter was higher than the quarter before in the top line. So I can see here maybe one quarter where it was a bit slower, and then maybe another. So like 2 quarters where it grew or was flat, grew a lot slower or was flat. I mean, just look at this graph. This is unstoppable. You cannot stop this growth there. It already says, just by looking at this revenue graph, it already says what kind of adoption this gets and what type of high quality services it offers. Okay, and also the fact that it has absolutely no cyclicality in the business. This is not something that you just turn off, like I said. But let's take a look at margins next. Gross margins around 80%, very typical for software as a service. And then operating margins 10 years ago was negative 16, quickly improved to minus 8, and then minus 3%, minus 1.6. This is excellent. This is the type of improvement that you want to see, going from 16 to 8 to minus 16, minus 8, and then minus 4. But this was better, minus 3. So it gets cut in half every single time, and then obviously became profitable. 1% operating margin, 4%, 4%, 5%, 9%, 12%, 13% in 2024, and now it's 14% trailing 12 months. But it's probably once they report, yeah, it's probably going to be something closer to like 16 in the next earnings report. It's going to get a bump there. But yeah, free cash flow margin, again, huge, very high, 30% and consistent since like many years ago, several years ago, 28 in 2019, 30%, 30%. I mean, look, excellent margins. If you don't know about this company, just go on YouTube and go search for demo videos on how to use this. This is something that has a very simple UI and boring and very non-exciting. It's very utilitarian. It's like an utility more than being fancy, but this is exactly the type of stock that you want to own when it comes to software. You want something very non-exciting and something that just makes other people become more efficient. And this is one of the companies that has been using AI since before ChatGPT has come out. So they have been buying NVIDIA graphics cards to train their AI agents even before ChatGPT came out. So this is not this is a pioneer in AI. This is using AI, one of the first adopters of AI. So yeah, net cash, look at this. They're sitting right now on top of $7 billion. They don't have any debt. Total debt, $2 billion. The cash interest on this debt is nothing. What else can we take a look at? Net income here, growing. Stock-based compensation is high, but it has slowed down quite a bit in the last few years compared to the free cash flow and free cash flow growth. Let's take a look at the number here. Free cash flow, 4 billion. It's still going up a lot at a 45-degree angle on this graph. And stock-based compensation has been slowed down a lot, which is exactly what we want to see. Yes, we want the company to pay for the talent, and for the enterprise value of 140 billion or so, paying 2 billion for the employees is not that bad, especially considering the top line growth that this has. What else can we look? Repurchases of common stock. They have been consistent buybacker of shares. So this is a very shareholder-friendly company. This is not some kind of share diluting trash. They do try to offset the stock-based compensation by buying back shares. But as you can see here, trailing 12 months, they did quite a bit more than the SBC by around 400, 500 million. So that's very nice to see. They're going to probably continue to grow this over time and completely overshadow the stock-based compensation and offer a real and nice return to the shareholders. But right now, the return is just going to come from price appreciation, from the company just growing a lot over time and improving margins. I mean, this is just the beginning. 14, 16%. This is not going to stop at 14 and 16%. Okay, this is going to go well above 20%, 25%, probably closer to 40%, I would say, comparing to the other software stocks that I own. Forward PE. Now, this is the very attractive part of getting into a very high quality company right now. The fact that it sits at a decade low multiple, 36 forward PE. For the amount of huge growth that this company has, 36 PE is nothing, is very, very low. This 36 PE, if the price just stays flat, let's say this doesn't move at all, 142, okay. If this doesn't move at all, in just about 3 years, this forward PE of 36 is going to be under 20, okay, it's 18 or 19 or so. Well, what else can we look at? So forward PE is, well, 85 right now, looks to be, I mean, it was trading at 900 5 years ago. So looking at 85, you would say, wow, that's very pricey, very, very expensive. Very expensive. No, it's not. It's very cheap for what it offers, for the amount of growth that it offers. Costco, which is growing at a single digit number, is trading around 50 PE. Okay. So also Walmart. What is this? 40 PE for Walmart. Walmart is growing 4% consistently. I mean, it barely covers inflation. So would you buy Walmart at 40 PE or ServiceNow at 20 PE? And considering that ServiceNow is very deeply embedded into enterprises and has a very deep vertical moat compared to a retailer. Okay, what is the value there in a retailer? It's not. Growth is very limited. Trends change. Margins can get very compressed, and they're already very small for something like Walmart. But anyway, any metric that you look here in the valuation is cheapest it's ever been for this company in its history. FCF yield 2.7%, again very acceptable and very good. Return on capital invested, let's take a look by quarterly just to see the trend better here. So as you can see, it's gone from negative to positive and it's growing, it's trending up, and last quarter report was more than 10%, which is excellent for a company that is still in the early phases of its growth. I mean, it's just been 5 years since this was profitable, so it can go like 15 years more having nice decent growth. That's how much that's how long the runway is for this company. And this is a much smoother graph, as you can see, return on capital employed, and you can see here the trend is even nicer, up 13% trailing 12 months. Excellent. Again, this is probably going to go to something like 30-40% over time, and then ROIC 25-30%. But yeah, that was it for ServiceNow. Next company I want to talk about is Qualys. So Qualys is a security and truth enforcement. Okay, this is something that has continuous vulnerability visibility, compliance evidence, and audit readiness. You don't buy Qualys to improve margins as a company, as an enterprise. You buy it to avoid catastrophic failure. Okay, this is again extremely sticky, underhyped. As you can see here on the graph, it doesn't have any hype to it. I mean, since 2012, it's grown more or less in line with the market. Actually, a lot faster than the market, but the last few years, not so much. Last 5 years, it's up 10%, a measly 10% for this company. But underneath, it's been growing very nicely, and we're going to take a look at the numbers. But yeah, you don't buy this this is not fancy software or optional software. This is extremely sticky and embedded in regulatory reality. Okay, 4P of 18, dirt cheap for this company. Double-digit consistent top-line growth. 10 years ago was doing 22%, 23%. Now it's doing 10%. Completely acceptable. The slowdown is completely acceptable and to be expected. Top-line growth, not as exponential looking graph as our ServiceNow, but still very high consistent growth. I would say probably not 45-degree angle, but like 40% or so. So it's not going to become exponential anytime soon, and it's probably not going to accelerate in the top line growth. But this company overall, it's been very, very solid, and this is the type of company, Qualys, that will run alongside ServiceNow. So these are the tools that I am looking for when buying and holding something forever. Something that you can't just rip it off, and if you try to rip it off, if you try to bypass it, things are going to implode. I have some companies where if they would disappear tomorrow, people would literally die. So that's the type of company that I want to buy and hold for a very long time. Gross margins, more than 80% and growing, slightly trending up. Yeah, 5 years ago it was at 77%, it's trending up to 83%. So growing margins always a very good sign, even though of course going from something like 77, which is already very, very high, up to 83%, it's not that much. It's just 5%, 6%. But the important fact is that it's going up. The trend line is important. This is a very important aspect because the stock price has not been doing very well. Top line is growing, margins improving, and the stock price compared to the S&P is just not there. I mean, it was left. This is very unliked and hated actually. While CrowdStrike and Palo Alto Networks is very loved, but things will come around because you cannot avoid reality. Look at this, operating margins again going up smoothly over time, more and more and more. We are sitting September last quarter earnings report 35%, all-time high. Free cash flow margins. Let's take a look by annual. 40% in FCF margins. This is kind of insane actually. It makes me, just going through the numbers, over the numbers again, makes me very comfortable owning this for the very long term. Cash and equivalents, 200 million compared to the market cap of 4.7 billion. They have quite a bit of firepower to do some buybacks, and they have done quite a bunch. I mean, look at this share change year on year, down 2% last year. Yeah, look at this. Share count going down consistently over time since 2018. So this is a company that already returns quite a bit of value to shareholders through their free cash flow it gives out to the shareholders already. Stock-based compensation, 77 million compared to the net income of 200 million, completely acceptable. And as you can see, net income growing nicely over time, very, very nicely, consistent 45-degree angle. And stock-based comp, it's kind of starting to flatline, 67 million 2021, and now we're at 76 million, exactly what we want to see. Repurchase of common stock, consistently doing more when the stock is down. In 2022, the stock was down more, a lot more than it is today, actually. Let me take a look. Yeah, 2021, 2022, so probably around this area, they started to buy back. This is exactly what you want to see. Management offering support to the share price by increasing and accelerating buybacks when it's needed. Right now, it's not needed. They just need to be consistent, and the price is gonna creep up over time. But yeah, the valuation has come down a lot. I mean, look at this. 2019, 2020, forward P of 34 and 42. Now coming down less than half it was trading at 4 to 5 years ago. So 42, 41. Today is 18 forward P. This is dirt cheap, extremely cheap. No debt, no excessive stock-based compensation, extremely high margins, and trending up. ROIC, return on capital invested, 27%, 28, 25, 24. I mean, this is excellent. I mean, you cannot ask for more. ROIC, return on capital employed, 37% back in 2022, 38%, and now it's 35%. Again, excellent. FCF yield, all-time high. So again, all of the valuation metrics are indicating all-time low valuation. Not all, yeah, actually all-time low for the hit. Even though we only see 10 years here, I can assure you before 2015, it wasn't trading cheaper than this. So yeah, another extremely high quality compounder, and something that you can buy and sleep well at night. Something that, you know, it just cannot be turned off, cannot be ripped off by companies. Look into it, what it does, how important it is, what actually means to have compliance evidence, audit readiness, and all these type of stuff. Okay, the next software stock that has come down a lot in price than that I have bought recently, and it's a candidate to buy and hold forever, is Manhattan Associates. This is physical world execution software, warehouses, fulfillment, transportation. If Manhattan goes down, goods stop moving. This is logistics infrastructure. This is not optimization SaaS. This is deeply customized, mission critical, and nearly impossible to rip out once deployed. Retailers use Manhattan Associates. Let's take a look at their sites, and I'm pretty sure they are mentioning a few customers here, but what I know is that Amazon, for their warehouses, use Manhattan Associates. That's how important this and that's how high quality this service is, because Amazon has the talent and resources to build their own infrastructure type of software here, but they choose to go with Manhattan Associates because it's just excellent, and failing at this supply chain execution would cost them billions and billions of dollars. This is not something that you can cheap out on. So trusted by world-class brands to deliver. Crocs, I mean, this is a retailer. Floor & Decor, Brooks Brothers. I mean, these are retailers. These cannot operate without the software that Manhattan Associates offers. They would probably have to come up with some other solutions, but it would cost them so much, and it would become extremely inefficient for them. So again, real-world execution software. This is the type of software that I like to buy and hold forever, not something that can change with trends, that can come and go and have their moat attacked, or some other type of competitor to come and threaten their business. Let's take a quick look at the numbers. I'm going to try to be a lot quicker now. 10 years ago, this was doing 500 million. Now it's doing 1 billion. So it's growing, not a fast grower. But again, when we are looking to buy and hold forever, we're not looking for the fastest grower, or we're just looking for survivability and inevitability. How likely it is for Manhattan Associates to exist in 20 to 30 years. The probability is extremely high. So you want something that's very deeply embedded into the economy, very hard to rip it out. And if you do try to rip it out, there will be basically explosion. This is kaboom. As things go kaboom. That's the type of stocks you can buy and hold forever, not retailers, not. So you wouldn't buy retailers, you would buy Manhattan Associates that can deliver and execute supply for retailers. That's what you want to be buying. Shares change, shares outstanding over time. They are doing buybacks, which is good. They have been doing buybacks consistently. I mean, look at this, -2%, -3, -4. Excellent. What more can you ask for in a software as a service company that has high margins, decent growth? They are doing buybacks. I mean, you just want them to be decent. You're not looking for 10x growth here. You're looking to deploy your capital, set it and forget it. Don't tinker with it. That's what buy and hold for me means. Forever. I mean, nobody who makes this type of videos on YouTube, buy and hold forever, they're serious about. They haven't put any thought into it. I mean, I've seen people trying to justify buying and holding forever a Walmart or Costco, or I mean, these things that can just get destroyed in the first recession that comes. But yeah, anyway, margins are again excellent, 31% free cash flow margins and trending up and consistent. What more can you ask? Balance sheet. Let's take a look at the cash levels, all-time high, almost 260 million to a market cap of 10 billion and a half. That's not bad. Let's take a look at long-term debt. Total debt 40 million, nothing. So nothing. What is the cash interest? The interest paid. Interest tax expense. Income tax. No, they don't have any interest. Yeah, so basically they don't have any interest expense. Stocks-based compensation 100 million. Net income of 200 million. Let's see, going up over time. Also, the SBC is quite, I wouldn't say concerning. It's still much lower than the net income, but we have seen in the last 5 to 6 years here a high growth in SBC, which, I mean, I accept growth here, but not, I don't want this to become exponential, and I don't want this to get out of control. Repurchases, so they're doing more than 3 times the SBC and share repurchases. So not only that they're offsetting completely the stock-based compensation, but they're doing an extra almost 200 million on top, which is fine. Completely acceptable. I mean, I'm buying this. I'm looking for around 7 to 10% compounded annual growth rate for this type of company. So they don't have to do anything crazy. Valuation has come down a lot. Not all-time high, not all-time low on this graph. In the last 10 years, it was sitting at around 26 times forward PE. Now we're at 34, but the share price discount is pretty significant. It's very steep. As you can see here, falling knife, down 50% very quickly. Brutally rejected, so that's signs that was a bottom there. Goes back up again, comes down, and we're zigzagging since November 2025. So it's probably the bottom was here. April 2025, we have had a retracement in the price, and now this is an excellent opportunity, and I'm probably going to add more into my position on eToro here. Let's see how much I have invested, like 2%. Manhattan Associates around 1.9% invested. Yeah, I'm probably going to add more once Adobe starts to take off. Novo Nordisk, we already took some profits from there, but I added more to ServiceNow because this is a hard deployment trigger, down 40%. This is not something I want to miss. But yeah, this was ServiceNow. No, this was Manhattan Associates. Let's take a look real quick. Return on invested capital, 50%. Look at this. I mean, 75% return on capital employed, and it's been higher in the past, and it's been consistently high. 40% at the minimum in 2020, when all of this, everything was on lockdown and people were locked into their homes. Yeah, that's very interesting. FCF yield valuation here, not all-time best last 10 years here, but used to be trading at 1.7% FCF yield. Now it's more than 3%. A lot better than the S&P 500 for sure. But yeah, you might say that you can also buy the S&P 500 to buy and hold forever for sure. But if you want specifically software, high margin software, high return on invested capital, 50%, this is going to compound like crazy. I mean, I said I'm looking to get between 7 and 10%. I'm probably gonna get quite a bit more than that, to be honest. Seeing these margins, I mean, at some point, the valuation has to come down because they're gonna increase buybacks more and more and more. They're gonna produce more and more in cash flow. Let's take a look at free cash flow. Yeah, 100 million, 2015. This is probably gonna start growing consistently. Looking at the ROIC and ROCE being so big and fat, I mean, this is kind of crazy. But yeah, let's move on to the next. Fourth stock on the list is Tyler Technologies. Tyler Technologies runs software for governments, courts, police departments, tax systems, public records. Governments don't move fast and they do not switch vendors easily. Once a system is in place, it can last basically for decades. These systems handle legally mandated processes. Courts records must exist. Taxes must be collected. Cases must be tracked. If Tyler Technologies software stops, the government doesn't function properly. And this is exactly the type of deep embedded vertical moat that I'm looking for when investing for the very long term. Having this type of moat, I could say, yes, I can sleep well at night investing my money into something like this, knowing that it's just not gonna disappear overnight or some kind of drama or a new competitors comes into the space. This is a slow, methodical, and deeply embedded. That's exactly what you want for a forever hold. Governments don't just lose vendors, they renew. So let's take a look at the financials here. 4P37, as you can see, it's come down from 641 down to about 450. Quite an okay discount. Let's take a look. Most people don't even have this on their radar because it's very unexciting. It's government work. Down 30%. That's not bad. Revenue going up consistently over time. Not as smooth as some of our other companies that we took a look over, but still very quite consistent. When you look at the percentages, it's not so 40% in 1 year, and then 16, and then 5. This is quite inconsistent, but I think they made an acquisition here in 2020 going into 2022. This is not natural growth. This is some type of merger and acquisition, it seems, because yeah, they were growing 10%, 10%, 11, and then bumped up to 42. This smells like an acquisition to me. Let's take a look at the goodwill. Goodwill, 2 billion, 2.5. Yeah, here it is. They made an acquisition. Anyway, let's take a look at shares outstanding. Are they diluting? We see a bunch of red here, which is not ideal, but it's not massive. 1%, nothing going over 2%, 3% here, but it might be because of the acquisition. This 3.5 and 1.7, we'll take a look. Take a look and see. But yeah, this is nothing too crazy. It's acceptable level of dilution. And obviously, we hope that in the future, we get more in terms of buybacks from this company. Margins are not so super exciting. This is not 80%, this is 46, so lower. But we're not looking for the highest margins. We're looking for the longest inevitability in the sense of, is this going to be around in 25 to 30 years? And the answer is clearly yes for this company, Tyler Technologies. Cash and equivalents, 800 million. The market cap is 19 billion, so that's not bad. They can do some buybacks if they want to. Long-term debt, looks like they don't have any long-term debt. They used to have in 2024. For 2025, this is missing, so they paid off all their debt, which is good. Total debt is 600 million. Net cash positive 300 million, so not bad. So as you can see here, they acquired using debt. In 2021, they went into negative territory, so they accumulated up until the acquisition 600 million here. They went into debt, they had negative 1 billion, and they paid off the debt, and now they're net cash positive. So that's good to see. They acquired the company, they got rid of the debt, and now that company that they acquired, it's fully assimilated into the whole corporation. Net income 300 million. Let's take a look at stock-based compensation. Growing up consistently over time. 150 million compared to net income of 300. This is not ideal. This is quite high. I would like the net income to start going up faster from here, or the stock-based compensation to slow down. Repurchases, they started to repurchase trailing 12 months, 174. So they were doing a bit here and there even before the acquisition, and then they stopped because they focused on paying off the debt. So I'm not I'm not someone who goes after dividend yields and buyback yields. I don't think that's important. I would rather honestly that they don't do any buybacks and they don't do any dividends at all, and obviously no stock-based compensation if it's possible. And if they do any SBC, I would just rather have repurchases only to cover the SBC, and that's it. And the rest, just keep it in the bank and look for acquisitions or look for some other capital expenditures that would expand the business and make it grow naturally over time. Free cash flow 600 million. This is not bad, obviously, when you take a look at the stock-based comp 140 million. It looks nice compared to the free cash flow of 618. So there's a lot to work with. They are very profitable and they don't have any debt. Decent margins, decent growth rate. And like I said, the moat is incredible. Now, valuation, is it time to buy it? 4P, 37 times today. They have been in the past at this level, 35 in 2018, and they quickly had a run up to about 76 times, which is very overvalued, but everything was kind of overvalued in this period, 2020, 2021. But they were, in September 2024, they were trading at 58 times. So we've come down a lot since then. So again, very attractive. It is a buy for me here. I have bought it. I do own it. Return on capital invested, not very exciting, around 5% right now. ROCE is looking to improve since the acquisition. They have been grinding back. So it's looking nice. Hopefully the new acquisition, it will make the whole capital employed of the company to produce more and more over time, more than 10%. Hopefully we're going to look at 11, 12 next year and so on. FCF yield 3%, again better than the market, than the S&P 500. Not dirt cheap, but you very rarely get the opportunity to buy something like this at a dirt cheap levels, because this is being bought by governments and this basically has very little competition, if at all. This has no competition. So yeah, it's not like you'll find, you're not going to see extreme drama with this company. It's going to be very boring. But if you're looking for buy and hold company, this is exactly what you want. Okay, next stock. Last stock on the list, fifth stock, is going to be Veeva Systems. Veeva operates inside pharmaceutical companies where mistakes don't just cost money, they cost licenses. So think about drug trials, quality checks, regulatory submissions, quality compliance reporting. Government and regulators expect documentation in very specific formats with full traceability. Veeva software is the tool that handles this. Pharma companies don't just shop around for alternatives every few years, because regulators, they trust the processes, not experiments. So once Veeva Systems is embedded, it becomes part of how drugs get approved and sold. Turning it off doesn't mean inconvenience. It means that you legally cannot operate. This is one of the strongest vertical software models in existence. Okay, I do own Veeva alongside my number 2 position in the portfolio here, which is Novo Nordisk. Novo Nordisk uses Veeva Systems. Okay, so Veeva is around here with 4%. I did buy it at a very nice dip. In December, we have had all of these type of opportunities and they started to bounce. So as you can see here, went from 306 down to 215. Great opportunity. I jumped on it and here we are. You know, this looked like this was the bottom. If it pulls down a little bit from here, like 5-6%, it's going to be another perfect opportunity. But even here, starting from here, it's not looking too bad. It's still off from all-time highs. But yeah, over the past 5 years, the stock is down 17%. But underneath, this has been growing a lot and has been coming down in valuation. This price movement that you see here going up 70%, this is purely from top line growth and margins expanding. This is not, and valuation has pretty much remained the same or has come down a little bit. We're going to take a look in a moment at the valuation. But yeah, right now forward P is 28 and the P ratio currently is 46, which is not bad. $40 billion market cap. Let's take a look at the top line. So a bunch of double-digit numbers, 16, 16, 9, 10%, 16, 26, 32. So this is very high growth as well. Not only that this is a very deeply embedded, this has a much deeper vertical moat than ServiceNow. And it's growing not as fast, but much faster than Tyler Technologies. I mean, look at this, how smooth. This dip here is probably an error. Very smooth and consistent growth, quarter over quarter. Shares change, everything in the red here, so we get a little bit of dilution. This is the stock-based compensation is quite high, and they don't do enough buybacks, it seems. So dilution, there is present dilution here, but not excessive. It's not Palantir type of, or some of the garbage Cathy Wood stocks. This is completely acceptable. 1%, 0.6. This is nothing to get worried about, especially when the company is still growing a lot. When it becomes very, very profitable, it's basically gonna start returning capital to shareholders, and this is gonna reverse, and they're gonna start reducing the share count. So gross margins, 75%, excellent for the type of company that it is. Operating margins trending up, had a little bit dip here, and then it recovered, and now it's at all-time high, 28%. Hopefully this goes beyond. Free cash flow margins, amazing. Over the past 10 years, it's been high across the board, 37, 48, no, 40, 43, 38. This is amazing. Cash and equivalents, 1.6 billion, all-time high. They can do buybacks with this. They can do a lot of stuff. Maybe, I mean, there's a lot they can do, but in the case where something has a very deep vertical moat, they cannot find many other companies that they can acquire. So they have to grow inside of their own business, but still this cash can help them. I mean, total debt, no debt, 90 million. This is nothing. Net cash, look at this. I mean, what are they going to do with the cash? It's not easy for them to just find something else to acquire. And from a strategic point, it doesn't make sense to just go on. And so they're just sitting on a lot of cash, not knowing what to do with. And they're probably going to start deploying this into buybacks. I mean, it's the only logical move. 6.7 billion. I mean, that's a lot for a market cap of 40 billion, and it's more than 10%. 15%, more than 15. Net income, 800 million, growing consistently, going up nicely over time. Stock-based comp is high, but as you can see here, it's slowed down a lot last few years. Exactly what we want to see. And net income, as you can see, it's accelerating. So this is the perfect situation to buy into. What do I mean by that? Stock price is down. SBC has slowed. Net income accelerating. They have a lot of cash on hand. They can start repurchasing a lot more. So they're doing symbolic. These repurchases are symbolic, and I don't know what they're doing. They're issuing some stock, and I'm not sure what's going on. I would not like this to continue for very long, and it doesn't make sense. Why would you issue stock if you're sitting on 6.5 billion in cash? Free cash flow also going up nicely and consistently, 1.3 billion. Very nice. I mean, the stock-based compensation is not a red flag. It's actually a green flag that it's been slowing down, and also green flag that the net income has accelerated last 2 years. So nothing wrong with the cash flow statement. Ratios here, let's take a look at the valuation. P ratio used to be trading at more than 100 times, has been coming down a lot, but not too much, not crashing down, because again, this company is very high quality. But as you can see, over the past 10 years, we are at a low of 47 times. 4P, definitely low, and also acceptable. Not acceptable, but extremely attractive, and I would say very cheap if you take into consideration the margins, the cash they have on hand. Why do you take the cash on hand into account? Because they can just start buying back shares, and the earnings are gonna go up, the EPS, earnings per share, and the forward PE is gonna get lower and lower and lower. So combine top line growth with the possibility of stock buyback, and this 28 is becoming very attractive. I mean, EV to EBITDA 35. They used to be a little bit cheaper in the past, but yeah, again, not super dirt cheap, but you will probably never get this super dirt cheap. And you, as an investment philosophy, you don't want extremely dirt cheap companies like 4, 5, 7 times forward PE and stuff like that, like maybe 10 times price to earnings. It means that company is not very highly valued, and automatically it's probably not a very good company. So when you're looking for value, when you're looking to buy something that can also offer you some value, yeah, sure, you're gonna be buying at a low price if you can, but it doesn't have to be extremely dislocated. Sometimes you get those opportunities, but buying growth at a reasonable level is fine. All-time high here, FCF yield, much more than the market is currently. So again, valuation, perfect entry point. So this was it. This was the final stocks. Let me know in the comments what other type of list like this, 5 stocks to buy, you would like to see, and see you in the next video.